Hey guys, Jay here. This is smarthelping.com. I'm available for more time to do some of the modeling explainers I want to do, so here we are. This is a model I've built a few years ago, and I just recently went through and did a pretty, and I don't know if it's called extensive, but I added about 4 or 5 updates to this. Added it to the plus version on smarthelping.com, which you can see uh, here, or sometimes if I modify an existing template I have for a customer, I will put it here if it makes sense to, if it's not too client specific. So these are all the updates I just did. This is the model I'm going to review right now. So let's go into that. um, so the main thing is, well, there's a couple main things. We adjusted the exit value on each property. So this is short-term rental. You could do 20 tranches of properties. You could define the amount of units in each tranche. So this could be a single property or a group. The average purchase price per unit, average renovation costs, how long the renovation takes, taxes, uh, and this is going to apply to all units. Financing assumptions, amortization, APR, if you're going to refi or not. If you do refi, you've got some valuation metrics here, LTV, and then the exit month, which you could dynamically change for each one. And then the exit based on the annual appreciation in this case. In the other original, it'll be based on a cap rate and the net operating income that the property produces. Then you've got all this rental pricing over here, daily prices, average rent growth, and then all your seasonality assumptions, variance from the base, and OPEX. Then we have annual expense growth and seller fees. So those are all the assumptions. So uh, now 1 second, I want to see what I was doing here with this taxes input. Let me go to one of the pro formas. Is that property taxes? It shouldn't be. Taxes, it's upfront cost. What was I? Oh, I think this was one of the adjustments to the model actually. I did the update for this client about 3 weeks ago, so I didn't remember. So they wanted a new column for either just they could do taxes or just some input for an extra cost that happens up front. So like renovations, they wanted to separate out taxes, which is fine. Might have been in Europe, maybe it was a VAT tax. I don't know, I can't remember. But anyway, so you've got an extra column here for that, which will go to all the different pro formas. You could see taxes hits right here. Yeah, I believe that was the update. And you can see this cost will hit whenever, let's say this was purchased in July, and we did, so July 2022. So that 25,000 should hit for that tranche. And you see July now, everything hits in July. There's that $25,000 tax, debt funding, purchase price, and then you got debt service and everything all starting there. Now the thing is, so you can see we can delay if we want. So let's say the renovation lasts 3 months. Well, now you can see that revenue doesn't start till October, whereas before we're starting in August. And that will all affect cash flow and your cash requirements. The model has each of the 20 pro formas monthly and annual views, and then that rolls up into a consolidated. Now you'll see some of the updates. One update, which I love when people want to do this, is the cash flow manager. So this is if we've got the entire 20 property tranches of cash flows all consolidated right here in this cash flow row. So another update the client wanted was to manage the operating account to figure out when they needed investments instead of just doing it all up front. they wanted to be able to add investments over time if necessary. So here you can see if you don't invest anything and we take out distributions, you can see here's essentially the bank account. So this is, let's say you wanted to go 4 months ahead of time and have a runway, so you go maybe 1.7 million. Okay, that gets you, not 17 million. That'll get you, and then you go in May, and based on, and then again, you'll time this up with when you decide to purchase different things, and you could see it all right here when you're going to need the cash. So maybe another, we'll do another couple months. Let's see, we get down to 2. Oh, I keep putting an extra 0, 2.6, and then here maybe you go 2.5. We get cleared off. We'll just go 2.8. So now you've got enough, and then you finally get into a stabilized operations, and now you start producing profits. And so this is the bank balance. This is how much profit you're generating each month, or cash flow. And then you could start distributions if you want. So you can manually define, you could do it quarterly or at the end of each year or what have you, and you could distribute up to obviously what's in the bank. So here I could go 2, 8, 4, 5, 5, 4, 5 if I want to distribute everything for up to that month. And then you start going again. Now there is automation around this as well, but some people like to do it manually. Like you could say keep a minimum of $1 million, and then it'll just, as soon as the operating account gets above $1 million, it'll distribute everything outside of that, and then at the exit it'll distribute the rest. That's logic I do a lot of the time. Also, you could do what month you actually start doing the distributions. So you can automate this, or you could just say no distributions till the year 15, which is kind of wild, but you could do that, and then put 80, 627, 988, and that'll put in a 4. Oh shoot, undo. Put this back to 0. You just copy and paste values here. There you go. So you get right to 0. Now that series of investor investments and distributions sits right on top of the entire project, so you can know exactly what you need and what you're going to distribute. And then that flows into the waterfall. So this is where we have options for an LP and GP. If you have that, if it's that kind of a deal, and then this will count the monthly internal rate of return. So it converts an annual. So this is a 10% hurdle rate. It converts that to what your monthly compounded rate is, and then starts applying that. Now, since we're not doing distributions, we're not getting out of tier 1 until the last month, and then we finally have a distribution. You can see here, this is the amount needed to get the 10% hurdle rate. Here's the check on that. So 16 million up front. Well, no, sorry. This amount up front over these time frames. And then this distribution equals a 10% internal rate of return. And then once we cover that hurdle, there's still 58 million left to distribute. Now we go to hurdle 2, which is a 15% IRR. Here's the monthly rate, corresponding rate to that. Here's a check, so we do get out of tier 2. Go to tier 3, 20% IRR, and we do not pass tier 3, so we actually get to an 18% IRR. You can see it's actually 17.9. So we don't get to the final split, which after 20% IRR, I think I put 50-50, yeah. So we don't get into the final tier for the promotion for the GP. In this case, obviously every scenario is different. You got discounted cash flow analysis down here as well, and the consolidated IRR and equity multiple. This would be for the entire project. Annual waterfall just summarizes what I just went over, but on an annual basis for each of the tiers. You got some charts here. And all that those data points flow back here. What else? So I think so. We added extra column. We did the annual appreciation instead of an exit cap rate, and then I added the cash flow managers. This logic here. I think actually that was it. Let me look back at the. I put notes in here. So annual appreciation, monthly schedule for investments, shows cumulative cash balance by month below acquisition schedule. Okay, so did I add that? Yes. Okay, so here, this is another interesting part. You can see what your cash position is. So this is pulling this row right here, which is obviously going to be affected by this. And that allows you to plan out these tranches and see, okay, when am I starting to build up cash? So obviously in April, I almost hit 0. Then I start building up. And you could manage the buying and selling of each tranche, and then most likely you would clear out all of this, put in what your strategy is here, and try to make it so as you get back to your target cash flow, you start to make a new investment, and so on. And then you can plan. So I think this was helpful in figuring out what you wanted these dates to be, and you can see how it affects. So if I were to say, instead of July, this happened in February, well, now we don't actually have enough cash. We're short here in April. So we'd have to either go and add it here or adjust the schedule, or maybe make this a little bit later until we saved up a little bit more. There, if we go, I'll extend that to May. So the client wanted this, which made things a little bit, oh shoot, I didn't switch, sorry. Let me go back here. So let's say, we're on ID2 and we put this to February. You can see now this is short. And, we have to go all the way out to May. Now we've got back to positive. But anyway, this view makes it easier to see what impact on cash flow your timing of these different tranches has, and when you purchase things, when you sell, what your all the assumptions around your rent and everything else, seasonality. Let me see if there was anything else. Time. Oh, shows the sum value of properties as total assets per appreciation, and add equity. Okay, got it. So we did do a couple more things. Over here, I did the equity multiple of the total of each tranche. So just what the tranche did, not what the entire project did. You can see the IRR of each one, and then the annualized ROI. So the annualized ROI is basically just the equity multiple minus 1 divided by the number of years you held the property. So 66% per year is what this needs. It's kind of like a cash on cash. This would be similar to cash on cash, but it's annualizing it to get the average. And it does include the exit. So that's a nice kind of snapshot of each tranche and how it performed based on the assumptions. This cash position chart obviously is corresponding to this. And then the other update was, what did I say? Oh, the chart. This. So this shows you how the properties are increasing in value over time. You can see from year 1 to 15, the little box is getting wider, and our total valuation starting at under 15 million. As we buy properties, this is going up, and then we stabilize, and now it just goes up at our annualized appreciation gets to whatever level. You can see in this case we're about at 30 to 33 million on the whole portfolio. Okay, so those are all the updates, but that's just giving you an example of, clients come in, they buy a template, and then If they need modifications, I'm happy to do that. Or you could do it as you see fit if you can. Now, if you do want, you can hire me right over here at smarthelping.com. My rate is $275 an hour. Usually I have pretty quick turnarounds. You can do 20 hours for a discount. Also, in general, if we go to the home page in the real estate section, you can buy the short-term rental base model. It's right here. Where is it? Short-term rental. Not short-term rental arbitrage. Here it is, short-term rentals. It's this one. You see here, this is the base without the updates that I just showed you. The updated one you can only get in the plus bundle, or the obviously the super smart bundle, which is everything on the whole site, all templates. All right. Well, that's all I got for you in this one. Like, subscribe. See you on the next one.